Welcome, Multifamily Investor Nation. I am your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And with us today, we have a very special guest, Elaine Stageberg. Elaine, welcome to the podcast.
Thank you. I'm excited to be here.
Absolutely. Well, okay. I know we have an amazing deal to talk about today. So many twists and turns. And it's the residence of DiscoverySquare, 129 units, Rochester, Minnesota. But tell us, before we get into the details there, tell us a little bit about yourself, how you got into multifamily, and where you're at today in the space.
Yeah, absolutely. So as you mentioned, my name is Elaine Stageberg. My husband, Nick, and I are real estate investors. We run our company, Black Swan Real Estate, together. We have just kind of a very normal story, starting out as real estate investors, rented the home that I lived in before we got married. That was our very first property. And one thing kind of led to another. And today we run a very large private equity firm. We have about $1/3 billion in assets under management, all long-term residential real estate. So we do single family and large multifamily. We're in Rochester, Minnesota, and Tacoma, Washington, which are two markets that we consider to be the blue ocean, very different than markets where many people are investing. We're vertically integrated. That's a big part of our business ethos, our values. And it's just a lot of fun to be able to run our company together, remembering all the way back where it started with the home that I personally lived in, and until today, talking about this deal that we just closed a few weeks ago.
Well, awesome. Well, let's dive in. Okay, so residents of DiscoverySquare, 129 units, Rochester, Minnesota. You guys recently closed this, like just a few weeks ago, right?
Just a few weeks ago, yep.
Okay, so let's back up the timeline. When did you find it, and how did you find it?
So the deal was technically publicly marketed by a local firm here that we have closed several deals with. We're in a smaller market, and so we really like what we call like local to local transactions. And so it was publicly marketed. We saw it, come across our email or something. I can't remember if it was an email or a phone call, but came across our desk. Immediately called the broker, reminded him of all of the other successful closings we've done together, and said, we'd like to put our hat in the ring for this one. And we knew right away that we really wanted it because it is a very large asset that's part of what we call our downtown campus. So Mayo Clinic is the home of, Rochester, Minnesota is the home of Mayo Clinic. See, I actually exchanged them there because Rochester and Mayo, just, you can't have one without the other. And we have a large contingent of apartment buildings all right in that downtown area. And we knew that this would just slot right into our portfolio. So we basically said on that first call, we want to buy this and we will do what it takes to buy it. And then because we have that history with him, we were able to have relatively seamless negotiations of finding out what the seller wanted, finding out what an ideal offer would be for the seller, seeing how that fit in with our business plan, and then going from there.
Awesome. Okay, so was there any competition with this deal before you guys, with your, putting in your letter of intent? Were there other groups bidding on the deal?
I don't know specifically, right? Because the broker didn't disclose much to us, but it's my understanding that in those early conversations, it was so evident that we would ultimately prevail as the buyer that we kind of raced to the top of the pile very quickly.
Okay, all right. So we kind of understand that the location, the unit count. What was the overarching business strategy? Because you and I were talking before the show, and there was one strategy the developer had in mind, but there's a totally different strategy that you guys took.
Yeah, so this building, it's a Class A multifamily mixed-use building. Really beautiful units, beautiful amenities, and a very prime location. And it just had the misfortune of being built in 2019. So as part of the development, the city required that the entire ground floor level, and this building is the size of an entire city block. So an entire city block of ground floor commercial, with the idea that the city is trying to move Rochester toward more of a walkable environment with shops and retail and just all of those things that make a walkable community, that I think in 2019 was a laudable goal. I can understand why the city made that a part of the development requirements in 2019. But we all know what happened in early 2020. So the building opened and it's successfully leased because there's such a demand for multifamily housing in this area. So the residential part of the building really has never struggled. But the commercial space to this day in May 2023 is still white box, unbuilt out commercial space. And from what I know of the owners, it was a family that built this building, very wealthy family, and they are much older than my husband and I, about 40 years older than my husband and I, and really thought that made perfect sense in 2016, 2017, 2018, as they're going through this process, that they would build it and fill it and sell it, and it would be a nice little thing to finish before they kind of capped off their careers. They actually don't have any experience in real estate. They're very successful business owners outside of real estate. And then that plan took a turn, and through COVID, they kind of hung on. And then eventually they went to their broker and said, like, we're ready to sell. Like, we don't know when the commercial will fill. We're getting older. We want to retire and go off to the cabin and just, enjoy ourselves and our grandchildren and everything. And just continuing to wait for COVID to unfold and for society to, kind of get back to that place that it was in, 2017, 2018, 2019. That's no longer interesting to us. And so we were able to come in as a group, 40 years biologically younger than the sellers, and we are hungry and we are able to wait, and we are willing to do creative things. And so right from the get-go, it was an opportunity for us to solve, just as who we are as buyers, to solve a problem for who the sellers are as sellers.
Awesome. I love that. And I know there's more to share here, but let's get back to the letter of intent and actually getting it under contract. How did you guys structure your deal in order to seal it?
Yeah. So we got this under contract in late 2022. And we all know that that was a time of, rapidly rising interest rates. And, you could just assume that if the Fed was meeting, that the interest rates were going to go up again. It was really just a matter of, would it be 0.5 or 0.75? And so that was a risky time for all of us in real estate. The property had a very favorable loan at 2.37%. And we instantly honed in on that, and we instantly knew that we wanted to assume that loan. In 2022, we had assumed, I think, somewhere between 5 and 7 loans. These are all local regional banks, no agency debt. And so we immediately contacted the bank and said, as part of this offer, in order to be able to offer the price that the seller wants, we have to be able to assume the debt at this interest rate, because the price makes sense at that interest rate. The price makes a lot less sense at what were the prevailing interest rates during that late 2022 time period. And we can talk about that process, because I think we learned a lot in that process, and a lot of value that hopefully I could offer to others who are maybe considering that. And then the gap that we had there was, because the seller, had brought their own down payment in the beginning and then had some debt pay down, the gap between what the bank still held and then what the seller wanted in terms of purchase price was pretty large. And we were unwilling to bring that much capital down to the deal. And so we worked with the seller to say, we're willing to hit your top line number if we can assume the existing bank debt, and if you carry the vast majority of it as a no interest, no payment seller carry for several years, so that we can do our value add plan, which we'll talk about here in a little bit. And then ultimately we were able to acquire a $26.7 million deal with $3 million down, and about 9 million of our debt, maybe 7 million, don't quote me on it, but about 7 million of our debt is at 0%, and the other 18 million is at 2.37%.
Wow, that's amazing.
Like basically free money.
Right? Okay, so you've got the debt, which is obviously like a big puzzle piece, like in this field. How else did you structure it? Did you have 30-day due diligence, 30 days to close, extensions? Like, what else went into the structure of the deal?
We are quite simple in our negotiations. I think part of that is that we're in the Midwest. Part of it is just who we are as people. So like as an example, we don't do LOIs. We only do purchase agreements. When we send our offer to a broker, they know that it's signed, it's ready to go. If their party is willing to sign it, that's it. We're under contract. So I don't know what the specifics were on this deal. If I had to guess, we probably did 30 days due diligence, 60-day close, maybe the option for an additional 30-day extension, maybe twice. I don't exactly know, but I know that we keep things very simple. We try to do all of our due diligence in about 10 to 14 days. We try to move very quickly. We have never had to extend because of a need on our end. We've extended many, many times for the sellers, and we're happy to do so if the deal continues to make sense. And we've never failed to close, and we've never renegotiated. We're just what we put on our PA in the beginning, that is what it is.
Mm-hmm. So what kind of earnest money did you put down with the deal? And was it hard?
We probably put down, my guess would be, we ended up only putting down $3 million total for the whole acquisition, probably $100,000.
Okay. And did
I know that I recognize that I'm like wishy-washy on these details because they're a little old in my mind, and they're just like not that important. Like I would venture that like 90% of our earnest money is hard because we know we're going to close. Like it is like no risk to us to do hard earnest money because we've never failed to close. And by the time we get to where we're ready to send that PA over, we're fairly certain that, you know, everything is going to work out. And we basically ask the sellers, like, what is an ideal offer for you? And then we see if that makes sense for our business plan. And then we go from there. And then everything else, we try to think of it as noise. Like, is it a good asset with a reasonable story of why the seller's selling it? Can we get good debt? Can we exercise our value add plan? Can we get all of our cash out in about 3 years? If we can do it in 5 years, we're happy, but really we strive for 3 years, and then we hold. We've never sold a single asset. So it's a really simple business plan. And as long as something fits into that box, we do it over and over and over again.
So, you know, I think there's still some, even though the details, seem, for lack of a better word, kind of maybe irrelevant because you have your box. I think the question here then I have for you is somebody new listening to this.
Mm-hmm.
100,000. I mean, maybe they're not going for the size of the deal. Okay, maybe that's not the case. But how do you get comfortable? And I have had the pleasure of meeting your husband and having lunch with him and just hearing him speak. I mean, you two are just like a powerhouse together. But how do you get comfortable writing that check, knowing that it's hard and that all of the other puzzle pieces, are essentially noise? Like, how do you get comfortable with that?
Yeah, that's
how can you help somebody figure that out?
Yeah, that's an excellent question. I think a big part of it is just doing it over and over and over, right? Like we weren't doing that offer 10 years ago when we first started, right? And we slowly upped the ante with our real estate investing. And we started investing with our own capital that we saved from our own jobs, with our own, we call it like the bigger pockets plan, like our own plan to get to financial freedom. Never envisioned that, one day down the line, we would be running a private equity firm and investing other people's money on their behalf. And just, one foot in front of the other. So single family homes, then we did single family homes with all cash. Then we did many single family homes with all cash. At one time we kind of built a pipeline. Then we built a property management company. Then my husband left his career in technology to run the company. Then I left my career in medicine. Then we did joint ventures. Then we started our private equity funds. So it was always just, one foot in front of the other. Bigger and bigger deals, never losing sight of our roots, which has always been that BRRRR business model. So we've never sold a single asset. We've never flipped. We've never done all sorts of things that real estate investors do. It's always been, can we buy something, put some effort and money into it, do a cash out refi, keep it forever, take that bucket of money and use it over and over again. And then just doing deals, just being in the market. We say we're never pencils down. We're always evaluating. That's why we were evaluating in late 2022 when, quite frankly, the market was crazy, right? Pricing was crazy. Interest rates are crazy, but we're always underwriting. We're always looking at deals. We're in relatively small markets. We're in what I consider to be blue ocean markets. And so we have really good relationships with brokers, with sellers. Almost every one of our transactions, we end up in direct negotiations with the sellers. My husband is a real estate agent himself, so he negotiates on our behalf. And then we're usually able to say, I bet we could structure a deal if we can speak with the seller directly. Of course, you're welcome to be there. We want your client to be represented, but we're trying to come up with a win-win deal. And I bet we could do that if we can just have like more open communication. And I know a lot of the things that we do, are not common in bigger markets or just in different markets. But I think that a big part of our success is that we are a breath of fresh air to people because we do things in a lot of ways our way. And there's been kind of some naysayers that have said like, well, you won't be able to scale that way or these sorts of things. And we've been able to do that. We're at $1/3 billion. This Residence of Discovery Square was the largest transaction in Minnesota so far this year. And just really approaching it from a perspective of how can we solve people's needs, right? Including our own needs, but how can we solve the needs of the people in this transaction? And then just going slowly, right? Like I would not recommend to someone that they do, a $27 million deal with hard earnest money and try to work with a bank on an assumption as their first deal, but either grow your own experience through real estate investing or connect with someone who has more experience and ask them like, well, what do you look for in a deal? Or how do you know this is a good deal? I heard Brad Sumrock say one time, and I totally believe it because I feel it too, like he knows a good deal when he sees it because he's looked at so many deals, right? So there's plenty of deals that we look at where we would not be willing to write such an aggressive offer. But because we look at so many deals, when we see the one that fits our business plan, where we feel like we can solve that seller's problem in a way that benefits us as well, then it just makes sense. And the risk of hard earnest money or any of the the closing periods, those sorts of things, like we just intuitively know from doing so many deals that risk is mitigated because of our experience.
Got it.
Is that helpful?
Yeah, no, I think it's wise.
A lot of it's faith, right?
Pardon?
A lot of it's faith of doing it a lot and having a sense about the deals and a sense about the players in the deal. And
well, it's also muscle memory too,
mm-hmm.
right? And being willing to step into action. It's not just the knowledge, right? But like willing to, I think sometimes, and I want to get back to the deal for sure, but I think sometimes, active investors, especially people starting off in the space, we call it analysis paralysis, but really what it is the fear of the unknown.
Mm-hmm.
Right? And so you can't control risk, but how can you mitigate as much as possible? And then you're going to take lumps. It's a matter of if, not, or when, not if. Like you will take lumps at some point in time. And when those lumps happen, how resilient and resourceful can you be? And then, the next time the lump happens, the next time that obstacle, rears its ugly head, it's not as scary.
Right?
Yeah.
The thing I would say about risk is take the minimum amount of risk that you can in the market, right? So 7 or 8 years ago, when we were doing single family homes, you could still get an inspection contingency and all sorts of things. And then the market got hotter and hotter and hotter, and those things just faded out of the market. But when the market allowed us to have lower risk, we had lower risk. And then now the market kind of requires a bit of higher risk because it's much more competitive, but always be asking oneself, what am I getting in exchange for this risk? Right? So like hard earnest money, is it that I can have a lower top line number because the seller knows that I'm really committed to selling, and maybe there's another offer on their desk that's a higher number that is wishy-washy earnest money that's not hard? Well, maybe they'll consider taking my offer even if the top line number is lower. So my kind of ethos is have the minimum amount of risk that the market will allow, and then always be asking oneself, in exchange for this risk, what am I getting?
I love it. Well, let's go back to the deal because we were talking before the show, the value add plan. There was like tons of things here. So I want to get in a little bit to the value add plan, but more importantly, before that, probably let's get into the due diligence. Here you had a building largely occupied, first floor, retail space. How do you do the due diligence on this property?
So in terms of the physical structure, it was built in 2019 by a builder that we respected. So we had just, general physical inspections in terms of we walk through every single unit, all of the common areas, have professionals for things like the roof, the electrical, the HVAC, those sorts of things, looked at all of the original building plans. It's such a new building that made it a lot easier. We've acquired several 70-year-old, 100-year-old apartment buildings. Due diligence on those is completely different. It's much harder, because of the age. And then in terms of financials, The building was managed by the property management company of the listing broker, who we have a great relationship with. We've acquired probably at least 6 buildings with that brokerage in the last several years. So we know what the transition is like with that property management company. So just requesting all of the contracts, all of the leases, all of the financials, all of those things. And we know, because we've worked with them, that they're trustworthy, that they get us the paperwork that we ask for, that, you know, after closing, their paperwork reflects what they told us during that process. So all in all, it was pretty simple. Really, the biggest piece of this deal was working with the banks and getting them to come around to allowing us to assume that debt, because the banks were very forthright that we don't really want to allow you to assume this debt because it's such a low interest rate. And we just kind of kept, you know, going back to, you know, the seller's kind of out of gas. The seller has said, like, they're done with this, and I don't think they're going to default or anything like that. But don't you want to bring in some young, hungry folks? And don't you want to bring in the strength of a private equity fund? And don't you want to bring in additional capital for the down payment? If you want all of those things, what we need from that is to be able to assume the debt here. There were 4 participating banks that we had to work with. Took about 6 months. So we were long done with, you know, getting everything situated with the broker, getting everything situated with due diligence, looking at financials. And then we just worked with the bank for probably about 6 months, just continuing to say, yep, we need to assume it at that rate. Yep, we need to assume it at that rate. Yep, absolutely, that's what needs to happen. It ended up that we did have a 0.5 point interest rate increase. So our final rate was 2.8% instead of 2.37%. And that was, you know, a little bit sad, but we were willing to do that to get closed and move on with the deal. But most of the time that we were under contract was spent working with the bank.
Well, and so, okay, so we know the rate that you closed at. You know, were there any lockout you know, in the assumption, is there lockouts, prepayments? Like, what kind of terms are there in this particular loan?
So there's about 2.5 years left on the original term. No prepayment penalty, which there's no way we would prepay it anyway because of that interest rate. And then that's about it. So we know we have about 2.5 years to exercise our value add plan, so that at that time we can do a cash out refi, repay that bank note, pay the seller carry, you know, what we owe the seller, and then have our final debt on the building.
So what is your game plan for the carry out loan? Because I know we get that question all the time. You know, people are like, you know, what happens next?
Mm-hmm. So all of our debt across the entire portfolio is all with local regional banks, with bankers that, you know, we personally know. We have lunch with them. We know their kids. They know our kids. Very much believe in, you know, local regional banks. And so we've already started talking with the bank that holds the note to say, I think 100% of the time when we have done a cash out refi, we have cash out refied with the bank that has the original piece of debt. And so it's your business to lose. And, you know, we know we're not going to get an interest rate in the 2s. We're not fools. But, you know, let's start thinking now of, after we finish our value add plan, when we have the new rents, the new NOI, you know, what can we do in terms of the cash out? And then we'll work with our other banks as well. You know, it's a large piece of debt, so banks are going to be very hungry for it. The banks that we work with are the size, usually they will need a participating bank. So even though that's over 2 years away, we are already having those conversations, getting our banks excited about it, helping them understand our vision, so that the moment we're ready, you know, like, we want to ride that loan out all the way to the very end, but not get into any risky period where that loan is coming to a close and we don't have, you know, our next piece ready to go. So I don't know exactly what it will look like, but the things that I can predict are that it will be with a local regional bank. It'll be fixed rate, 5-year term, no prepayment penalty, full recourse. My husband and I signed full recourse on everything. That's a big part of the reason how we get, you know, low interest rate, fixed rate debt. And just other than that, you know, pretty simple.
All right. See, there was a capital raising component to this. You know, did you have a pref? Was there any GP catch up in there? What were the splits, IRR hurdles, stuff like that?
So, as is the theme that we're picking up on here, very simple. So we put this into Black Swan Real Estate Fund 2. That was a $30 million fund. All of those things you mentioned, we don't have any of those in our fund. We have no fees whatsoever, no asset management fee, capital event fee, disposition fee. Basically, our investors bring the money. We do all the work. All of the profits go back to our investors until they're completely repaid. We tell people to plan for about a 5-year period for that. Historically, it's never taken more than 3 years. And then after that, we hold forever. So our investors are at a $0 basis in the deal. We're at an infinite rate of return. And then it's a 50-50 split, and we hold for about 25 years.
Interesting.
Very different.
Yeah. So how do you keep the lights on while the deal's running?
So personally, Nick and I are financially independent from the real estate that we did before we started our JVs, before we started our private equity fund. So in that several years where we're doing the value add plan, when all of the profits going back to our partners, it's not untrue to say that during that time, we're working for free in exchange for our future equity stake in those deals, but our family's taken care of by our own real estate holdings.
Okay. So there's no acquisition fee, asset management fee, disposition fee?
That's right.
All right. So let's talk a little bit about takeover, because you said there was some, you mentioned deeds and stuff like that at the beginning that we haven't actually touched on. So what's the story with that?
With the contract for deed, or?
Yeah, the contract for deed. Yep.
So because the existing bank debt was, a little bit lower, because the original seller had brought their own down payment when they closed the original loan, and then had paid down the note over the last 4 years that they've owned it, we didn't want to bring that much capital down. We would have needed to bring probably $8 million, and that was a number we were unwilling to bring. So we worked with the seller to say, we can hit your top line number. In order to do that, and we can close quickly, and we've never failed to close before, and we're going to make this really simple. In order to do that, we need to assume the existing bank debt. We need you to carry the rest at 0% interest until that when the bank loan refinances is when we'll pay the seller their seller carry. We tried to get it with no money down. We tried, and that did not work with either the seller or the bank. So we ended up bringing $3 million, which went directly to the bank. It was used to pay down the principal on the loan so that the bank was comfortable with allowing the assumption. And then the family that owned it before, they have that seller carry for the remaining amount that we will pay them when we do our cash out refi.
Got it. All right. Well, let's wrap up. So what did you find that was easy during this deal that you thought was going to be a little bit more challenging? And what was something that you thought was going to be more challenging that actually ended up being easier?
So we had done many bank loan assumptions in 2022. And so we thought that it would be pretty easy to assume the loan. If you had said, when we were writing our purchase agreement, that it would take 6 months to convince the banks, I don't think we would have believed you. We're like, we've done this with several other banks. It takes maybe 8 weeks. They have to get it through a couple committees, and, a couple people have to sign off. And it wasn't until we were under contract that the vital piece of information was revealed, which was there were 4 participating banks. So the bank that the bank that we were working with, they were all on board because they understood the story, and they understood the new operators that were coming in, the additional injection of liquidity, the backing of the private equity fund, the value add plan, which is we're converting that commercial space to residential space, and we'll have 2-story kind of townhome units in that space. So we didn't have a chance to talk much about the value add plan, but working with the city to say the commercial plan has failed. Just COVID hit, none of us could have predicted it. The commercial plan has failed. Let's convert this to residential. So that bank understood it, but the 4 participating banks that we were a layer removed from were much harder to convince. And that's why, they had to go through all of their committees, and the committees met at different times, and participating bank 2 would come back with, something that they wanted, and then we'd have to kind of circulate that to all of the participating banks. So it was definitely an exercise in patience. I really give all the credit to my husband, Nick, for that, of just staying committed to the vision and just being in, great communication with the broker, with the seller, to say, we're definitely going to close. We've never failed to close before. We'll come up with a different plan if we have to, but I think we can get the banks to agree to this. And eventually they did. So that was much harder than we anticipated. And then the part that was easy was, we know this area because we have a lot of buildings in this area, and we know this broker and the previous property management company very well. So the moment it came across our desk as this building with this broker, I just remember Nick and I looking at each other like, this will be super easy. Like, we've got a great relationship. We've closed many deals before. We actually closed another much smaller deal while we were under contract on this deal with that same broker. So it's all about relationships, right? And doing business with the same people over and over and over again.
Awesome. Well, Elaine, thank you so much for sharing your experience and insights with us here today. If listeners want to find out more about you, how can they get in touch?
Yeah, absolutely. The name of our company is Black Swan Real Estate, and you can find us at meetblackswan.com. Tells you a little bit about our company, my husband and I, our track record, our calendars, our newsletter, all of those things. Meetblackswan.com.
Awesome. Well, again, Elaine, thank you so much for your time today. We look forward to hearing about future deals.
Absolutely. Thank you for having me.